Script 2, investors. Same starting money, same 30 years. The one on the left picks stocks, reads earnings reports, watches CNBC, pays a financial advisor 1% a year. The one on the right buys a single index fund, then does absolutely nothing. After 3 decades, the lazy one ends up with about $260,000 more. That's not a typo, and it's not luck, it's math. Specifically, 3 numbers that almost nobody talks about. I'll break down all 3, and by the end, you'll see exactly why the smartest investors in the world are betting on doing less. So let's start with the first number, 0.5. That's roughly the difference in fees between an actively managed mutual fund and a low-cost index fund. The active fund charges around 0.6%. The index fund charges 0.04%, sometimes less. 0.5% sounds like nothing, a rounding error. But here's where most people get the math wrong. Fees don't just cost you the fee, they cost you everything that money would have earned. Every year, compounded. Invest $500 a month for 30 years at a 7% return. With an index fund's tiny fee, you end up with about $508,000. With a typical active fund eating that extra 0.5%, around $535,000, you just paid $53,000 for the privilege of getting worse results. Because, and this is the part Wall Street really doesn't want you knowing, most active funds underperform the index they're trying to beat. 88% lose to the index. Which brings us to number 2, 10.1. That's the average annual return of the S&P 500 since 1957, through wars, recessions, dot-com crashes, 2008, COVID, all of it, roughly 10% a year on average. Now adjust for inflation, and you're looking at about 6.5 to 7% in real terms. That's the number to remember. Here's why it matters, the rule of 72. Divide 72 by your return rate, and you get the number of years it takes your money to double. At 7%, your money doubles roughly every 10 years. Put in $10,000 at age 25, don't touch it. By 65, that's about $160,000. You did nothing. The market did the work. Which brings us to the most important number of all, 0. That's how many times you should try to time the market. A study from JP Morgan looked at the last 20 years of the S&P 500. If you stayed invested the whole time, you got about 9.8% a year. But if you missed just the 10 best days, out of roughly 5,000, your return drops to 5.6%. Miss the 20 best days, you're down to 2.9%. And here's the kicker. Most of those best days happen within 2 weeks of the worst days. So the people who panic sell when the market crashes, they're almost guaranteed to miss the recovery. This is why the math of index investing is so brutally simple. Low fees, broad market exposure, time in the market, not timing the market. You don't need to pick winners, you own the whole market. The losers get replaced, the winners compound, you just keep buying. Now, this doesn't mean index investing is risk-free. The market can drop 30% in a year. It has. It will again. But over any 20-year window in modern history, the S&P 500 has never lost money. That's the trade. Stomach the short-term noise, collect the long-term math. So if you've got your emergency fund locked in and you're ready to actually start building wealth, you don't need a stock-picking strategy. You need a boring, automatic, low-cost index fund and the patience to let those 3 numbers do their thing. Next, I'm breaking down the exact 3-fund portfolio most index investors use to cover the entire global market, and the one common mistake that quietly wrecks the math we just talked about. Until then, drop your first investing question below. I read them.